The stock market does not go up in a straight line. In fact, even in an uptrend, prices tend to follow a wave-like motion. So prices will go up, go down for a while, go up, go down for a while, go up, go down for a while, and so on and so forth. So a falling stock market, be it in an uptrend or in a downtrend, is part and parcel of price movements. So in today's video, I'd like to share with you how to take advantage of a falling stock market, even if you are a beginner. And I'll be sharing with you some of the criteria that I use to take advantage of a falling stock market. So stick around in this video if you want to discover this criteria so that you can use it for your own investing in the stock market to not only generate returns but also minimize your risk in a falling stock market. The first thing that I want to tackle is how we view the stock market when it is falling. When it comes to a falling stock market, many investors tend to view this as something negative. And it is normal. However, if we want to take advantage of a falling stock market, we need to change our view and how we approach the stock market when it is falling. So when written in Chinese, the word crisis is composed of two characters, wei and ji. So the Chinese characters for crisis is wei ji. The first character wei represents danger, while the second character ji represents opportunity. And this illustrates a very important point. As with most things in life, there are always two sides of the coin. And the same thing is true in a crisis. In a crisis, there are dangers all around. However, at the same time, there are also abound with opportunities. So in a falling stock market, there are two sides of the coin. We can either view it as a crisis or as an opportunity. And the way an individual views this falling stock market, either as a crisis or as an opportunity, can affect their performance in the stock market. There are typically more opportunities to profit during periods of uncertainties. And a very good example is during the Great Depression. During the Great Depression, more millionaires were created than in any other time in American history. So during periods of uncertainties, there will undoubtedly be dangers around. However, at the same time, it typically also provides more opportunities to profit. This is the price chart for the S&P 500. And if you take a look back at the chart in the earlier part of this year, the S&P 500 suffered quite a substantial decline in prices, 35.41% to be specific. That's quite a big fall in the stock market. However, if you take a look at the point where prices bottom at this level over here, and you extend to where we currently are at over here, prices managed to rise by about 50%. While it's very hard and near impossible to predict the stock market bottom consistently, even if you did not buy right at the bottom, and maybe buy at points at around here or at this level over here, you'll still make quite a substantial returns in the stock market. Right, so when the stock market falls, you are presented with two choices or two pills like in the matrix. You can choose to either take the red pill, which presents an opportunity, or you can take the blue pill, which represents fear and panic. Hopefully, if you've been through this video up to this point, you will view it as an opportunity. Now it's also a great opportunity to smash that like button if you have enjoyed and learned something from this video. If you have made the choice to decide when the stock market falls, to view it as an opportunity rather than in fear and panic, your next question might probably be, is what do I invest in when this opportunity presents itself? So right now I'll be sharing with you the criteria that I take a look at. These are the three buy criteria that I take a look at to guide my decisions and investments during a falling stock market. The first criteria is strong fundamentals. I will only invest in companies with strong fundamentals during a falling stock market. Some of the things that I take a look at to determine whether a company has strong fundamentals or not are whether a company has competitive advantage, economic mode, strong financials, growth potential, sector trends, and so on and so forth. In a falling stock market, stock prices of most companies typically decline during this period. However, you only want to invest in those companies with strong fundamentals, because these companies are more likely to be able to weather the storm and even thrive during a falling stock market. But for companies with weak fundamentals, these companies are unlikely to perform as well, and some might even have trouble surviving, let alone thrive during this period of time. With the pandemic, the S&P 500 is only up by about 1.6% year to date. This does not mean that there were no companies that were able to perform exceptionally well during this year, 2020. Amazon, a company with strong fundamentals, Amazon which has an economic mode, strong financials, growth potential, and in a sector which is performing well, has managed to outperform the S&P 500 quite substantially. Amazon is up by about 58.8% year to date. Another company which has managed to perform exceptionally well this year is Enphase Energy. It has strong growth potential and is in the solar industry which is performing very well during this period of time. In fact, Enphase is up by about 252.98% year to date. So even in midst of this pandemic and in an underperforming stock market, companies with strong fundamentals still tend to do well. However, this is just one side of the spectrum. There is also another side to the spectrum, and that is companies with weak fundamentals. Companies with weak fundamentals tend not only to be unable to match the S&P 500, but also underperform the S&P 500. One of such companies is Delta Airlines. Delta Airlines is in an industry which has been hit hard by the pandemic, and this is reflected in its stock price. Delta Airlines is down by about 48.87% year to date. Another company in an industry which has been hit hard by the pandemic too is ExxonMobil. ExxonMobil is in the oil and gas industry, which has been decimated by the pandemic. And year to date, ExxonMobil is down by about 51.99%. The main point is not all companies thrive, let alone survive during bad times such as in a falling stock market. And that is why my first buy criteria is to invest only in fundamentally strong companies. The second buy criteria is to invest in fair valued or undervalued companies. Fair valued or undervalued means that the intrinsic value of a company is greater than or equal to its stock price. During times of economic prosperity and a booming stock market, it is typically harder to find companies whose intrinsic value is higher than or equal to its stock price. In a falling stock market, on the other hand, it provides us more opportunities to find companies whose stock price is closer to its intrinsic value. Because in a falling stock market, stock prices of most companies also tend to fall. And this allows companies whose stock price is above its intrinsic value to fall and converge back closer to its intrinsic value. In other words, we can view a falling stock market as a big sale, where great companies with strong fundamentals are up for sale. And that's my second buy criteria, to look for companies whose intrinsic value is greater than or equal to its stock price. The third criteria is buy and invest in these stocks with a long-term view. Because with the first buy criteria, that is, if we invest only in fundamentally strong companies, the stock price of these companies have a very high probability of rising over the long run. However, in the shorter term, there might be price fluctuations. Let's take a look at an example. This is the price chart for Enphase, which we have taken a look earlier on. Enphase Energy is a company with strong fundamentals, mainly because it has strong growth potential and is in an industry which is rising. And this is reflected in its stock price. Year to date, Enphase Energy is up by about 252.98%. This took place in a relatively longer period of time, over 11 months to be specific. Instead, if we view it in a relatively shorter time frame, we might have exited our position around this point here where stock prices declined by quite a fair bit. And subsequently, we would have missed out its huge rise in stock price. So the third buy criteria is to invest for the long term. Because in the short term, there are bound to be price fluctuations as a result of the emotions in the markets. But in the longer term, stock price tend to follow the fundamentals of the company. So if we had followed our first buy criteria, which is to invest only in fundamentally strong companies, then we can be sure with a high degree of certainty that in the long term, the price of the companies that we invest in will rise. So to recap, the three buy criteria are: firstly, we want to invest only in companies with strong fundamentals. Second, we want to invest in companies who are fair valued or undervalued. And lastly, we want to invest for the longer term. And if you follow these three buy criteria, I believe that you'll be able to take advantage of a falling stock market. Hopefully you guys have enjoyed this video. If you did, make sure you subscribe to my channel so that you don't miss out on future videos such as this. In fact, you can check out my channel right now because I have a lot of other videos on investing, trading and the stock market, which I believe can help you in your own journey in the stock market. I'll see you in those other videos to your financial success.